Have you ever felt relieved after buying insurance? Like something important is finally handled. You sign the papers. You make the payment. You tell yourself, at least I'm covered now. And for a while, that feeling sticks. Until one day, something actually happens. A bill arrives. A claim is denied. A number you didn't expect suddenly matters. And that's usually when people realize insurance didn't work the way they thought it would. Not because they were careless, not because they chose the wrong company, but because insurance coverage is rarely understood the way it's experienced. My name is Alex. I spend a lot of time thinking about how financial products feel safe on paper, but behave very differently in real life. Insurance is one of those topics that feels settled once you buy it, even though most of the important details stay invisible until the moment you need them. If you find yourself thinking about money in a quieter, more reflective way, you might want to subscribe. And with that in mind, let's talk about why your insurance coverage isn't what you think it is. Most people don't misunderstand insurance because they're careless. They misunderstand it because insurance is sold as certainty, but functions as conditional support. That difference matters. Insurance isn't designed to eliminate risk. It's designed to manage it in very specific, predefined ways. But when we buy insurance, we don't think in terms of conditions and definitions. We think emotionally. We think, if something goes wrong, I'll be okay. And that belief is comforting. The problem is, comfort and clarity aren't the same thing. Insurance feels simple because the buying process is simple. You choose a plan. You see a monthly cost. You see a few reassuring phrases like coverage, protection, and out-of-pocket maximum. Your brain fills in the rest. It assumes coverage means safety. It assumes limits means certainty. It assumes paperwork equals preparation. But insurance doesn't work on assumptions. It works on definitions. And most people never read or internalize those definitions until it's too late. Here's the part most financial advice ignores. Insurance isn't just a financial product. It's an emotional one. People buy insurance to reduce anxiety. They want to transfer fear somewhere else. They want reassurance that worst-case scenarios won't ruin them. That emotional need is completely human. But it also makes people less curious. Once anxiety drops, attention drops with it. And insurance relies on that. When people say they're covered, they usually mean one of three things. They mean they have a policy. They mean they're paying premiums. They mean they expect help if something goes wrong. But insurance coverage isn't binary. It's layered. Coverage depends on timing, on cause, on classification, on exclusions, on thresholds. You're not covered in general. You're covered under specific circumstances, defined narrowly. And anything outside those boundaries is your responsibility. Most insurance frustration comes from the gap between what people expect and what insurance actually does. People expect insurance to step in immediately. Insurance often waits until you've absorbed a large portion of the cost yourself. People expect insurance to simplify emergencies. Insurance often adds paperwork, approvals, and delays. People expect insurance to remove financial stress. Insurance often reshapes it instead. That doesn't mean insurance is useless. It means it's incomplete by design. One of the most misunderstood aspects of insurance is the idea of thresholds, deductibles, co-pays, co-insurance, out-of-pocket limits. These aren't small details. They're the core mechanism. Insurance rarely protects you from the first dollar of loss. It protects you after a certain amount of pain. Until then, you're on your own. So if you're financially unprepared for that initial stretch, insurance doesn't feel like protection. It feels like a promise that starts later than you expected. Out-of-pocket maximums sound final. They sound like a cap, a ceiling, a worst-case number. But in reality, they're conditional ceilings. They often exclude certain services. They reset annually. They don't include premiums. They don't prevent upfront cash flow strain. So even when you technically hit a limit, financial stress doesn't disappear. It shifts. Insurance assumes you can front costs. It assumes you can wait for reimbursements. It assumes you can handle timing gaps. But real life doesn't always align with those assumptions. Bills arrive before reimbursements. Expenses cluster during stressful moments. Income disruptions often happen at the same time as claims. Insurance doesn't smooth cash flow. It changes who eventually pays. That distinction matters when you're living month to month. One of the quiet dangers of insurance is false confidence. People take on risk differently when they feel protected. They save less. They hold less cash. They assume coverage will handle surprises. But insurance doesn't replace financial resilience. It assumes it. When people mistake coverage for preparedness, they become fragile. And fragility is expensive. The turning point for most people comes when they stop asking, "Am I covered?" and start asking, "What happens before coverage kicks in?" That question changes everything. It reframes insurance as one layer in a broader system, not the system itself. Insurance stops being a safety net and becomes a backstop. That mental shift reduces disappointment and improves decision making. Insurance works best when it's boring, when you don't expect it to solve everything, when you don't rely on it for small problems, when it's reserved for truly disruptive events. In that role, insurance can be powerful, but only when paired with margin. Emergency funds exist because insurance is incomplete. They cover deductibles. They bridge timing gaps. They reduce panic. Without that buffer, insurance feels adversarial instead of supportive. You're constantly negotiating, waiting, and worrying. With a buffer, insurance becomes quieter, and quiet systems tend to last. Another misconception is that more insurance always means more safety. But insurance beyond your financial capacity can backfire. High premiums reduce flexibility. Overlapping coverage creates complexity. Unnecessary policies drain cash flow. Insurance should reduce risk, not crowd out stability. If premiums force you to live too close to the edge, the system is misaligned. Insurance doesn't create security. It modifies risk exposure. Security comes from margin, from flexibility, from options. Insurance can support those things, but it can't replace them. That's why people with similar coverage feel very different levels of stress. The difference isn't the policy, it's the foundation underneath it. You don't need to cancel insurance or obsess over fine print. You just need to see it clearly. Understand what insurance doesn't do. Plan for what happens before it helps. Avoid relying on it emotionally. Build buffers where insurance expects them. Lower expectations where definitions apply. That alignment reduces friction. This perspective can feel unsettling at first because it removes the illusion of total protection. But clarity isn't pessimism, it's realism. And realism creates calmer decisions. When you stop expecting insurance to save you, you stop feeling betrayed by it. Once you understand insurance properly, your behavior shifts. You value liquidity more. You prioritize margin. You become less reactive. Insurance becomes part of a system instead of a substitute for one. That's when financial stress starts to ease. Most people don't feel frustrated with insurance because it fails. They feel frustrated because they expected something it was never designed to provide. Insurance doesn't eliminate uncertainty. It redistributes it. And when you understand that, insurance becomes less disappointing and more useful. You don't need perfect coverage. You need realistic expectations. Progress with money doesn't come from feeling fully protected. It comes from understanding where protection ends and preparing for what comes before it. And when you do that, insurance stops feeling like a promise you hope you never test and starts feeling like a tool that quietly supports the life you're actually living. That's when it finally makes sense.